risk markets have clearly come a full circle. So is the worst of the reciprocal tariff scare behind us? That's the question we're asking in today's Indianomics. Now watch this, the table that will come up for you. Pre-April 2nd, that is the pre-reciprocal tariffs, the US indexes, say S&P for instance, was at 5670, NASDAQ 17,150 thereabouts. Post-reciprocal tariffs, they fell about 15%, as you can see. And now, after the US-China deal over the weekend, they are back above their April 2nd levels. Likewise, you can look at the Nifty, or you can look at the dollar index. The Nifty as well, 23,350, falls about 15% after the reciprocal tariffs, and now back above the April 2nd, or back above the reciprocal tariff levels. Likewise, for the dollar index, it's not quite climbed back to the pre-reciprocal index levels, but the rupee definitely has. It fell to a low of 86.50. Gold is the other way around. Gold being a haven when risk aversion is high. It was high during the time. It was low during the pre-reciprocal tariff. After the tariff, because risk aversion was at its height, gold went to a high of 3,500 and now is back to the pre-reciprocal times level. So the question we are asking is the worst of the tariff threat over? And if yes, which assets will smart money chase? First, I'm joined by Neeraj Seth, founder and CEO of 3R Investments and formerly head of fixed income at BlackRock. Neeraj, thank you very much indeed for your time. That really is the first I'll ask you the big question and then come to the nitty-gritties. Do you think the markets have priced the worst of risk aversion?
I think the markets certainly have priced out all of the risk from the tariff and more. Obviously, there's an element of positioning that plays a role here, but I do think looking at the 120-degree turn, not 180, from President Trump, I do think the worst of the tariff scare is behind us. It's not done, it's not over. And the fascinating thing is that the investors are actually celebrating a 10% across the board tariff and still the remaining uncertainties in front of us. But it's not as bad as what we saw on April 2nd.
Yes, I agree that it is 120-degree turn and not a 180-degree turn because the president has said this is a 90-day truce. But is the market seriously pricing in something worse than 30% tariffs on China or a return to very high tariffs?
So I do think the markets, in fact, are moving more towards pricing even below whatever the last number around 30 that was in the news, for a simple reason that in any negotiation, if you start from 0 or whatever the last number was, or 10 that cross the board tariff versus 30 as the discussion point, the markets would expect the meeting point to be somewhere in the middle. So the pricing that I see at this point actually is reflecting a better outcome than even that 10 and 30 that obviously President Trump has been talking about.
Okay, let me ask you some unfair questions first. You are a fixed income expert, but I'm going to ask you if the best of gold is over for the moment. If risk aversion of the worst kind is already priced in, then gold doesn't go back to $3,500 for now?
If I have to predict, gold will go back to 3,500, but it'll take time. Part of the reason, exactly what you said, the near-term risk averseness and the uncertainty has come down, which is bringing gold back down. But if I take a step back and think about the world that we live in and the global reserves that sit in US dollars, the exposure the world has in US dollars, I do think the systematic reallocation is still going to happen over the coming years, and gold will be one of the beneficiaries, whether it's in the central bank portfolios or individual portfolios. So it's going to be a structural bull run, but a cyclical correction that we are going through. And I do think right now, near term, you probably have more to correct on the gold, given the uncertainties coming down and market is pricing the other side. But longer term, I still think gold will go higher.
Okay, so that is something like a buy on dip strategy that you're giving us. Okay, let me come to now the Asian, where smart money will go. Do you think now smart money chases risk assets like equities?
I think there is some reallocation happening. There's also, as I said, the technical backdrop of positioning. The CDAs were short given post the moves in the market post April 2nd. I think that readjustment is happening. I do think the smart money will still look at more diversification, first of all. Very high concentration that you see at this point in the US equities and US tech for a number of investors. So I think diversification is going to be one element. And if I take that lens, and think about the markets that will benefit. In my view, Europe will get a little bit of that reallocation benefit. Japan and India, in case of Asia Pac, will get that benefit. So you will see some of that money flowing back in these markets.
Okay. Now let me come to credit. India, even at the worst of times, continued to receive money in the bond funds. I think there was practically a couple of weeks when we didn't get, otherwise money was coming. How will bond funds look at Asian credit and particularly Indian credit?
So broadly, the Asian credit, I would say, is at this point fairly priced. I do think the spreads have a risk of widening, and because credit is not an asset class that loves uncertainty, and that's something which hasn't gone away from the market. So credit, I think, still has a little more risk of widening if you take a 6 to 12 month view. India is slightly different, and part of what we have talked about in the past, that when you look at the Indian markets, one, you have a fairly big high quality market, including the government bonds, PSU, and small corporates in the capital market perspective. And then you have the growth of private credit markets. And the global exposure, the foreign exposure in the India onshore story, despite all the news flow, is still not very high. So I do think India will continue to see those flows on a structural basis, at least for the foreseeable future.
Oh, yes. We also got a lower than expected inflation number for the 4th month running. So there are other reasons why Indian bonds are looking very attractive, even for domestic investors. But coming to the one, asset class which has defied all the risk move up and down, US bonds. I mean, 4.53 after you've seen what one must say is, some end of uncertainty. What explains the rise of US yields?
Well, part of it is obviously the markets are going through the respite, and hence you are seeing the sell-off in the bonds, which had a little bit of a tailwind or a support because of uncertainty and the risk of recessions that the markets are pricing in. Okay. And equally importantly, if we look at the fiscal financing and the monetary policy path, I still think there's a challenge there. On the fiscal financing, US still has a fairly heavy fiscal financing with close to $2 trillion of deficit that needs to be funded this year, and it's not coming down anytime soon. And on the monetary policy path, which is even more complex, I do think the Fed is sitting in the middle of very dense fog of uncertainty, both on the inflation as well as the employment front. So it's going to be hard for the Fed to move. Their best case scenario is to sit and wait. So between the financing, which is pushing the term premium higher, and the Fed uncertainty or the lack of Fed moves, which is keeping the front end also pricing out a little bit of the rate cuts. I think looking at the curve, the way it's behaving, I'm not at all surprised. If anything, I do believe the long end can actually keep backing up more.
Oh, going towards 5, you think?
I think 30-year crossing 5 is, well, we're not very far to begin with, but I don't think that should be a surprise. You still, when you think of fiscal financing, end of the day, the clearing price is a function of supply, demand, and where obviously you could get the investor interest. And the foreign demand is, although hasn't gone away, but it's not as strong for the US treasuries at this point.
Okay. Time permitting, I wanted to ask you a little more about US treasuries, but let me come to the dollar index. We have seen the dollar index recover somewhat from the sub-100 levels, but give us your view on whether dollar strengthens from here on, and therefore the dollar rupee in particular, not other Asian currencies.
So medium horizon, I'm still in the camp of dollar weaker. And that's mainly to do with more of the flow picture that you see on the back of the tariffs, the global exposure to the US assets, which is north of $30 trillion in the liquid markets. And hence, as some of that reallocation happens, I do think the dollar still has potential to weaken further. On the dollar, INR is interesting because you have, in addition to what happens to the dollar, you have RBI sitting on the other side. I think that stays more sideways, with potentials, like, if anything, over time, some strengthening driven by the flows.
Okay. Well, some strengthening because of the flows, yes. Neeraj, now a big question. We may not have time to flesh it out completely. Do you think the next big problem for all financial markets will not be the end of this 90-day period, but potential tax cuts by the US government, which perhaps is just a few weeks down the line?
So interestingly, that's an important point because the market can normally focus on only one thing at a time, and that focus will go towards tax cuts as we cross middle of the year. So you're right. I think that focus shift will happen. That also, to some extent, keeps the tailwind for the markets in the near term because obviously the regulatory aspect and the tax cuts still have a bit more of room for the tailwind to be there. So I think that will move. Now, the interesting thing will be, I would say, the bigger point the markets will focus on as we get into July will be the earnings from the second quarter, because the uncertainty that got created was April 2nd onwards, which is not captured at all in the first quarter earnings. So the second quarter earnings, you start to see a little bit of initial impact of these changes. And I think that will be more important in my view.
Okay, then a quick last question. Because of that, will US exceptionalism fade or will it rise?
I think
because of the tax cuts.
I think on the margin, the US exceptionalism little bit fades, partly to do with obviously the policy uncertainty that has been created. But when I look more from a corporate perspective in terms of innovation, growth, the technology aspect, the overall focus on shareholder value creation, the depth of the capital markets, I think US still remains an important market. It's more a question of how much exposure a non-US investor should have in that market. But it doesn't change the focus on the return on equity and the shareholder value creation that we have seen over the last 40 years.
Okay. Well, out of time. Thank you very much for joining us, Neeraj Seth. But we will pursue this theme of whether the worst of the reciprocal tariff fear is out of the market. Thanks much for watching this edition of Indianomics. We'll be back with Chartbusters.